All right, welcome everybody. I'm here today just to talk a little bit about a couple things. Waleed actually asked me originally to talk a little bit about first-time homebuyer programs and some of those options available to them. That was probably about 2.5 weeks ago, and I actually wanted to add a couple additional items, just everything that's gone on in the last week and a half in terms of information that's just kind of been released about mortgages and some of the stuff potentially coming down through the government and whatnot. So actually, I want to go ahead and start with, I'm sure many of you have heard about the 50-year mortgages that's being talked about, as well as Fannie Mae and what they're doing with this minimum 620 credit score and kind of what the potential implications, pros and cons are on both of those before I jump into the first-time home buying options. Okay, so first off, just about the 50-year mortgage. Just generally speaking, do you guys have any thoughts or initial comments on the idea of a 50-year mortgage? Are they muted or?
You guys have to unmute yourselves.
No, yeah, sorry. Hey Gary, it's Aisha.
Hey.
How are you?
Nice to meet, or nice seeing you, Aisha.
Nice
I've talked to you a few times. Yeah, I talked to you a few times.
Yeah, of course we did. Gary, I've heard about that previous to what is going on for the whole week, and as it's coming on, on our on our feed. My question on that is the interest. For the first few years would be interest only. What are the plans on that? Because that would take away the equity as we build being in a house for years, 50 years mortgage. Because
I didn't recognize it, but this looks cool. Where's you from? Oh yeah, now it clicked. Yeah.
Nabil.
I don't know. Can you hear me?
That's not me. I think that's phased on. Mute
Phase
yourself,
on?
guys.
Okay, thank you. Sorry, Nabil.
I'm so sorry about that, guys.
So that was my concern, my question regarding how the interest would be pan out. The 50 years, would it be the first couple of years only interest? I don't know what that is. I mean, how that's going to be like.
Yeah, so they haven't really released any actual details of that nature. I'm sure there's probably going to be some interest-only pieces to it. There's probably going to be fully amortizing. Of course, in theory, fully amortizing would be better for the long run. But I think it's one of those things where I'm kind of seeing a lot of real estate agents in particular love the idea, of course, because that 50-year term equates to lower payments, which means increased buying power. I'm seeing a lot of people on the mortgage side saying, both this is good and it's potentially bad. I think the main thing is really kind of understanding what exactly is happening with that. I did actually a calculation at about $400,000 for what the difference in the payment would be, and it actually came up to be about $249 difference depending on the interest rate. And when you're talking about buying power, have we had transactions where that $239 made a difference? Absolutely. Have we had situations where you would think $239 would make a bigger difference than it does? That's also true. I think the main factor that's gonna, really kind of show whether or not it's going to be beneficial is what's going to be the interest rate attached to that 30-year mortgage. Historically, what happens is obviously the longer the term, the higher the rate. So I'm curious as to, if we get to that point where it is approved and it becomes a thing, how much difference is an interest rate on a 50-year loan going to be over a 30-year loan? All right, because
that's an interesting take on that.
Because if you increase the rate over, because obviously a 15-year a mortgage has typically so what I would consider significantly lower rate than a 30-year. 20 is typically slightly higher than you have the 30-year rate. So if you up the interest rate on a 50-year rate, then is that gonna wash out the savings that you would have potentially had by extending the term, or how much is it gonna eat into that monthly savings? And then at that point, the question becomes, is it really worth it? A lot of the pushback or other commentary that I hear against the 50-year is, oh, well, I don't want to be paying for a mortgage for 50 years. Okay, well, who wants to pay for a mortgage for 30 years? And take it a step further, who actually holds a mortgage for 30 years as it stands now, right? Nobody. If you actually look up the average term that somebody holds a mortgage is typically 6 to 7 years. And then there's a chunk that holds it typically for 9 to 11, but very few people really hold a mortgage for a 30-year term. Typically, they're going to either refinance or sell that property and move on. So, the timing, I don't know that it's relevant. I think the bigger question as this, continues to kind of evolve is going to be, what is the actual rate going to be and what are the terms going to be? But none of that, unfortunately, has been released. And it's interesting because, does anybody know, generally speaking, how long the 30-year loan has been around?
Not really. Not that I know of.
Anybody else have an idea as to when the 30-year mortgage actually became a thing?
Want to take a guess? 75?
Okay, before that? It actually was, I believe it was under FDR, right after or soon after the Great Depression. It was actually, I believe, like 1940, 1946, somewhere around there. And at that time, in order to purchase a home, you typically put 50% down, and your mortgage was actually a 3 to 5 year balloon, and typically it was interest only. And so when the 30-year loan came out, everybody was losing their mind because that was a big difference. And I feel like we're kind of doing that again. So, will the 50 years stick? I don't know. It depends on the terms. Will it make a difference? Again, it's kind of too early to say, but I definitely found it very interesting how honestly polarizing it's already gotten after only, a week or so. The other thing that kind of came out this over the last week and a half or so is going to be the removal of the 620 minimum credit score for conventional. Ben and I were talking earlier, and I thought that was really interesting because there's been, various changes that Fannie Mae has talked about or have actually put in place, and it's, I guess, interesting in theory and in concept. But again, how does it play out? I think it's very early, but it's obviously creating a lot of buzz right now. But, an important aspect when you're talking about, loan requirements is, will it go through the automated underwriting engines? Just real fast, for those of you who don't know, you have two automated underwriting engines. You have LP and DU. Basically, you take an application, you put all your information in it, you submit it through that automated underwriting system. It will then come back and assess the overall, what we would consider risk on a file, right? So let's say your minimum credit score requirement is 620, you have a 621. Maximum debt to income for, in this case, conventional loan is 50%. Let's say you're at 49%. Let's say you've had a couple mortgage lates and whatnot. A couple just general lates. Technically, you meet the requirements for conventional, but when you're meeting the bare minimum on the credit score, you're just squeaking by in the debt to income, and you don't really have a lot of reserves. Let's say you're doing a bare minimum down payment, even though you are hitting all of the check boxes, that loan will not go through an automated underwriting system because the risk level on it is too high, right? So that's an important concept to understand, because if you remove the credit score requirement from your written guidelines, you have to also update the automated underwriting engines so that they accept those more risky scenarios, right? If you have a 580 credit score or a 575 credit score and you want to go through conventional, but it's still reading the risk levels all of the same, yeah, you can take applications below 620 all day long, but if they don't go through that automated underwriting system, you're gonna have a extremely hard time getting that loan to closing, right? And so it's important to kind of remember the overall big picture of what's going on, and not just, hey, great, we don't need the credit score anymore, right? So that's another thing that it's actually been all over my feed especially this last week, and I'm kind of seeing a lot of people prematurely putting out information without actually knowing or having all of the information in order to make some of the statements that are being made. So just be careful and watch that. Okay. Any questions on any of those two pieces before I jump into the first-time homebuying program or programs? Nope. All right. So first-time homebuyer programs. Okay. Have you guys heard of Virginia housing? Yes. Yeah. Well, Ben. All right. So Virginia housing. So basically, it's a program in the state of Virginia that essentially they will give money to help first-time home buyers purchase a home. Okay. Now, this particular program is specific to first-time home buyers, and it's important to understand the definition of a first-time home buyer, because it doesn't necessarily mean someone who has never purchased a home before. Okay. So the way Virginia housing defines a first-time home buyer is anybody who has not purchased a home or lived in a home that was their primary residence that they were on the deed for. Okay, so let's say you purchased a home 5 years ago, lived in it for a year, and then moved out and was renting that property, and now you're in a rental. Life happened, you had to relocate or something, right? You haven't lived in your primary home that you own for the last 4 years in that scenario. So technically you are actually considered a first-time home buyer, even though you own an investment property, because you're not living in your primary residence. So that's an important distinction. And then another popular one that people don't realize is, let's say, you bought a house, you sold it, and you've been renting for the last couple years, or last 3 years. Let's get specific. Last 3 years. Again, you meet that 3-year requirement. So you don't necessarily have to be a true first-time home buyer. You just have to meet their definition of a first-time home buyer. Okay. So under Virginia housing, they have quite a few different options, but specifically for first-time home buyers, there's two main ones that I'm typically running for applicants. So the first is going to be the grant option. Okay, so with the grant, the way that the grant sets up, and this is, I've talked to a few of you already about this program, and I was using an example, and you guys sort of latched on to the dollar value. So it's important to make sure you understand exactly how it works. So the way the grant works, it's not a preset or predetermined amount. It is a percentage of the sales price. So the most popular option is going to be the FHA grant, which we all know usually requires a 3.5% down payment. So with the grant, they would give you 2.5% of the purchase price, such that the borrower is now making their 1% down payment from their funds. Okay. If they did the conventional option, they would do the what we refer to as a Fannie Mae 97. So they would make a 3% down payment normally. So what Virginia Housing will do is they'll give you a 2% grant in that case, so that you're again making a 1% down payment. Okay, so the purchase price will determine the amount of the grant. So in Virginia, is everybody pretty much in Northern Virginia? Like above Fredericksburg up to DC, and then within like Manassas West or Centerville? Okay, so in that's we're gonna obviously we all know it as DC metropolitan. That's how Virginia housing defines it. And in this area, you can go up to 800,000 in a purchase price under their program, as long as you meet their qualifications. So if you're maxing out at 800,000 and you get a 2.5% grant, that's 20,000 that you're getting as a down payment grant. Okay, that money doesn't have to be repaid or given back. It's a true grant. It's not a silent second where there's another mortgage sitting on the loan that's just sitting there without a payment. It's truly a grant that they will give on the day of closing. Okay, again, you have to make a 1% down payment. With the conventional, it works almost the exact same. You're just adjusting the amount of the grant so that you're doing the down payment. You're doing your 1% down payment. Now, that down payment money, if they truly have, like on some of these bank statements that I've been seeing recently, $400, $500 in their bank account, and they can't come up with a couple thousand, you can get a gift from a family member, okay? And the most popular family member that gets rejected is a cousin, because that's not a family member as defined by FHA. FHA actually has a list of what they consider eligible family members for a gift donor. So as long as you meet that list, you know, father, mother, sister, brother, aunt, uncle, grandma, grandpa, they actually in recent years opened it up to a domestic partner. So boyfriend, girlfriend, however that all situation works, that works. But cousin is left off of the list probably for obvious reasons. Okay. So in theory, you know, if they have somebody that's willing to give them the 1%, and you can qualify for the grant, you truly can buy a house without having to make a down payment, which is kind of awesome. Okay. Now, the minimum requirement, credit score requirement on that's going to be 620. So at 620, you can do the grant. If you are above a 680, you can actually have a few more options open up to you. Okay, so does anybody have any question on the grant before I jump to some of the other, or one of the other options with Virginia Housing?
In terms of,
I have a quick question, sorry, Gary. So would the interest rate, would that be higher because we are getting the grant or they're getting the grant? Would that make a difference on the interest rate?
It makes a difference, not with the interest rate as it pertains to Virginia Housing, because there is a change when I jump into the next option, but that would be their basic rate. Now, because you're doing a down payment assistance program, the rate would be slightly higher than if you did your own down payment, but you're not talking about a lot. You're talking about an 1/8 to 1/4% difference.
Okay. All right.
Okay.
And then you can refinance this later? No, there's no time on it, how soon we can refinance? Just a regular 6 months?
Correct. Yeah, there's no prepayment penalties on that. But yeah, you would follow regular rules on that.
Oh, nice. Okay. Thank you.
does the interest rate makes a difference in terms of rate? I mean, the credit score, sorry, makes a difference.
No. So that's one of the huge benefits for Virginia Housing, is they do not have credit score adjustments. So, well, depends on which side of the credit score spectrum you're on. If you have your 620 is going to get the same rate as a 800. Yeah, they don't do credit adjustments. I'm gonna get ready to do that once I go over the next option. Yeah, we'll do that one. Okay. All right. So the next option they have is they have a 100% financing program. Okay, and this one is probably, in terms of assistance programs, probably one of the best ones that I've personally used. And with their 100% option, what they do is they do a second loan that would normally be your down payment. So if you're doing a FHA loan, you would normally have a 3.5% down payment. So what Virginia Housing will do, they'll do a 96.5% first loan, and then they'll do a 3.5% second loan. Now that second loan will be amortized at the same exact interest rate as your first loan, and it is also a 30-year loan. Okay, so it's great because all of the other down payment assistance programs that I've come across that aren't through Virginia Housing, they typically are going to be 2% higher above the first rate. So if your first rate is at 6.5%, then their second rate will be at 8.5%. And instead of it being a 30-year loan, Virginia Housing lets you do it as instead of letting that on the regular ones, like the regular outside programs, those typically are 10 or 15-year terms. Virginia Housing will let you do it on a 30-year. So it helps keep your overall payment much, much, much lower. Okay. Now, If you have above a 680 with that program, they'll actually let you do a 5% second. And you can use that extra 1.5% to put towards closing costs, or you can use that 1.5% to buy down your interest rate. Okay, so definitely a pretty cool feature with Virginia Housing, and that's pretty much why it's my go-to with them. Because in terms of rates and closing costs, they're definitely the most competitive one, period. Like there's none other, at least in Virginia, that I've ever heard of that are more competitive than that. Okay. What was your name?
My name is KB.
KB? Okay, so KB mentioned something about income limits. So I've been doing Virginia Housing at this point for about 19 years. And so I've sort of seen their income limits rise a lot over the 18 years. It's gotten to the point now where income used to really be a pretty limiting factor. With the way they've set their income limits now, they're very, very, very good, especially for this area, okay? So they have it broken down into two categories. You have 2 or less in your household, or you have 3 or more in your household, okay? And it's physical, like already birthed individuals. You can't say I'm pregnant, so now I have 3. Okay, it's actually birthed living individuals outside in terms of number of people. Okay, so for 2 or less in the Washington D.C. area, as long as your household income is not above $148,000, then you can do the grant or you can do the 100% financing. If your income is below $174,000. Then you can't do the grant anymore, but you can do the 100% financing. Okay, so if you kind of think about that in context, $174,000 in this area to qualify through Virginia Housing is pretty generous, at least in my opinion, for the Northern Virginia market. And that again stretches all the way down to Fredericksburg, up to Alexandria, Arlington, out west as far as Centerville and Haymarket, and then down to right inside King George, like not King George itself, but just north and east of King George. Okay. Does anybody do in the Richmond area around here?
We do a little bit.
A little bit. Okay, so Richmond, your limits are a little bit lower, 96,110. And then anybody do Culpeper? Okay, 98 and 115. Okay, so most of the stuff I see though is in this Northern Virginia area, so I'm typically looking at 148 and 174. That information is available. It gets updated annually, and it's just a Google search, Virginia Housing Income Limit, and you'll come up with the tables where that's all at. Okay. Any questions on that so far? Because we need to talk about a little bit about household size and income requirements a little bit more, and then I want to go into 100% financing for not necessarily first-time home buyers, and then that'll be all I have. Okay, so any questions on that?
So I know you mentioned like the household size, talking about somebody's not just to make, like, what if you have a partner? Does that also include it, or?
Yeah, so this is where I'm very intentional with when I say household size, okay? So household size, so you have, of course, you have household size, and then you also have qualifying income, okay? So Virginia Housing is very specific. When you are doing their grant or when you are doing their 100% financing, they are talking about household size and all of the income in that house, okay? So let's say you have a husband and wife that are on the loan, purchasing the home technically. And then they also have a set of parents that are living in the house with them who, let's just say, are on disability or Social Security. And everybody's living in the house together. Even though mom and dad going on the loan are the only ones applying, we have to look at everybody in the house's income that's living in that property. So you necessarily use the grandparents or parent or whoever, the Social Security income in qualifying, but you have to incorporate it to verify whether or not they're under the income limits.
So you accumulate all of the income to determine whether they reach threshold.
Correct. So probably that, I think I'd use that off the top of my head to illustrate the point, but maybe a more relevant one would, let's say husband and wife both work, but the husband's buying the house and he's the one on the application, right? So in that case, when we qualify, let's say he's making, 145,000 on salary, okay? And the wife is working. Even though she's not on the loan, we still have to pull her income information. And when she goes over that 148, or when they combine go over that 148, then in that case, they can't do the grant. As long as they're under 174, then they can still do 100% financing, even though she's not on the loan. Right? Now, how do you verify that? Well, you'll verify it based on the documentation in the file. If you see the bank statements when it gets to underwriting, because I know a lot of times we try to coach and steer and help on how to get through certain hurdles. Well, when they see the bank statements and then there's these deposits coming in, underwriting and Virginia Housing will ask, where's that income coming from? So you know how like on a lot of times programs will say they won't question any deposits below 1% of the sales price, right? I'm sure everybody's heard that before. With Virginia Housing, every deposit gets questioned. Because if you have side businesses that you don't claim, if you do, regular reoccurring income generating activity, that has to get incorporated, not for qualifying, but to verify you're within the income parameters.
So that only stands if the husband and wife do have joint incomes, joint statements, joint bank accounts, right? So let's say that the husband, he has a solo bank account.
So then also as part of the application, there's an actual disclosure that you have to fill out that states all of your sources of income for the household and all family members living in the household. So, yes, correct. I see where you're going with that. If the bank statements were completely separate, I guess you would pass that hurdle, but then when you're filling out that document, you would be committing mortgage fraud twice, once at application and once at closing. And that's probably not a route a home buyer would want to go down.
That would be mortgage fraud because you did not claim the other spouse's income, even though you have a separate bank.
Correct. Because it's household income. It specifically states household income. Yeah.
So even if it's separate, it's still going to be accumulated.
Yep.
Oh, man.
Yeah. So you want to be careful on that kind of stuff. 100%. And we can go into more detail later as well. Okay. Any other questions on that? So as I mentioned, Virginia Housing, that's definitely the go-to that I like, just because of how lenient the rates are and closing costs. There's no origination fee with it, which is relevant because we have a couple other options for, let's say, somebody who doesn't fall into the household income limits for Virginia Housing, but still can't do a down payment. They don't necessarily have to technically be first-time home buyers, but we still have 100% financing options available for them, okay? Now, the downside to those programs is they do have a 1% origination fee, and the interest rate will be higher than the Virginia Housing rate. Today, Virginia Housing is at, I believe, 6.5%. I looked at it yesterday, so it probably hasn't changed. The Virginia Housing rate's at 6.5% for the grant. For the 100% financing, the Virginia Housing rate it's always 0.25% higher. It's at 6.75 for the 100% financing. With our in-house assistance programs, that rate's probably going to be about 7%. And then also, unlike Virginia Housing, it has a 1% origination fee. And then that second mortgage is also amortized over that shorter term I mentioned earlier. You have two options, a 10-year and a 15-year, depending on your credit. Okay. So if you have somebody that you're talking to and they don't have down payment money and there are a first-time home buyer, by the way Virginia Housing defines it, Virginia Housing is a great option. But if they are not necessarily a first-time home buyer or they don't fit into the parameters of Virginia Housing, we do have other options that are available to help cover that down payment piece as well. Okay. Any questions on any of that? No?
Information is something I wish I knew years ago.
Should have found me 18 years ago, 19 years ago.
It's Ben's fault.
For what?
Not Ben's fault.
It's coach's fault.
All right, cool. Any other general questions about anything in particular while I'm here before I bounce?
So if our agents want to work with you
Mm-hmm.
In regards to any one of these programs, what is the best way for them to do that? Like, how do you operate? Do you just want them to take somebody that they spoke to who's interested and pass them over to you? Do you want them to
Sure.
do a call with you? Yeah.
I think I'm pretty flexible and pretty laid back. However, you feel your customer is most receptive is how I would prefer it. I know Waleed sometimes just does a group text. I know sometimes very rarely actually, he'll send an email. That's Ben's thing. Ben likes emails. He'll put us both on an email and just say, hey, reach out. I've had a couple people from other places. They'll, send me a text message. Actually, no, I've had, you've done it. I had somebody else. He was newer. I can't remember off the top of my head, but he'll text me while he's on the phone. Not phase on. It was before that. This was like maybe almost a year ago. He'll text me while he's talking to her. Hey, are you available to jump on a call? I'm talking to somebody right now. If you want to do that and you want to pull me in while you're talking to them, I can't always promise I'm 100% available, but at least in the 2 or 3 times I did it, I'll do that. However the most efficient way to get somebody moving, because that's the hard part. The hard part is getting to them to actually send in the paperwork we need to complete the pre-approval. So however the most efficient way to do that is, that's cool. If you're talking to somebody and you text me and say, hey, I'm talking to somebody, are you going to be available in like 5 minutes? Ben kind of did that the other night. It was mad late. He was like, hey, I just got off the phone with so-and-so. Can you call him right now? I was just like, are you joking? All right, cool. If that's what it takes, that's what it takes. And, I called them. He sent in all his information. We had to do some income stuff because he had a little bit of a special situation. But yeah, I talked to him, relatively late. I can't always do it. But, whatever I need to do to try to help get people moving into that pre-approval step, to me, it's worth it.
The time frame, I'm sorry, were you going to ask something?
Go ahead.
Okay. The time frame for the pre-approval for the Virginia housing is similar as long as they've submitted all the documents. It's the same as?
Yeah, because we do it here, and then once the loan is done, then it goes to Virginia Housing for them to sign off. So most of the time, if you have vanilla, cookie cutter, follows instructions very well, there's no additional questions, most pre-approvals can be done either same day if we get it early in the day, or the next. Sort of just depends on clearly I'm not doing pre-approvals right now. So anybody who, been sent some pay, I can't look at the pay stubs right now, right? So sometimes, I do have schedule conflicts. Most of the time I can, adjust stuff real fast and just make it work. But at least to get that initial review, I'll typically have that done within a matter of hours. If sometimes we have a situation where I guess in theory I could guess and assume we'll be good, I don't work off of assumptions, because the last thing you want to do, or last thing I want to do, is have to call you when we're under contract and say, hey, well, the income's changing because. So if there's gray areas on aspects of the file, I typically will request additional information, or if it's a kind of tricky, I'll actually put it through underwriting up front so that we don't have mistakes happen during the process. After appraisal money is spent, inspections out, you done been to the house another 4, 5, 10 times, you've begged this agent to accept your offer, and now you're sitting with egg on your face because I didn't want to do the upfront legwork. That doesn't happen. Anything I have questions or concerns about, I will address up front during the pre-approval. So in that case, they might take a little bit longer, but in those instances, you're talking to like a matter of a couple days. I've never had a pre-approval drag out more than 4 days.
As long as everything is submitted.
As long as I get everything, yeah. Now, if I get an ID and I get a W-2, but I'm missing another W-2 and I'm missing stuff, in most cases, I'm not even gonna start it. Because if I don't have all the information, what am I gonna come back to you? Well, credit looks good, but we don't know the income, so I don't know what to tell. Like, that doesn't do you any good. Yeah.
Two questions. So, I'll start with, is the credit soft or hard pull? And secondly, for the Virginia first-time home buyers, is there a requirement for how long they must reside in the state?
Okay, so I'll answer the easier one first. The credit is whatever you want it to. Well, I always do hard pulls unless you specifically tell me you want a soft pull done for them, or unless they specifically ask for a soft pull. And the reason being is two reasons. Number one, a soft pull just gives me the paper data so that I can put the information into my system, but I can't run automated underwriting programs on it. So you may have somebody that has average credit, they got a decent amount of money, but it's not great. And it's kind of like in that gray area. Remember, I was talking earlier about high risk loans. You may be gray across the board. I can't run an AUS on that. So unless it's like 800 credit, they got a surplus of 50,000, 100,000 in the bank, and it's just like, I will quit my job before I let this deal fall through good. Unless it's solid like that, I can't do a pre-approval without a hard credit. Second reason is 9 times out of 10, a soft pull tells me there's two things going on. One, you're not serious about moving forward. Once we have you pre-approved to buy a house, you're just out here gathering information, which is perfectly fine. Okay. Or B, you're basically getting ready to pin me up against 4 or 5 different lenders because you just want to shop, which again is fine, but that's going to change my approach and how I address and talk to that individual. Not like it would be disrespectful or anything like that, but I got to do more digging to figure out what's going on in this scenario. What are the red flags? What am I looking for? Because at the end of the day, just like y'all, I don't get paid unless I close the deal. And if I need to get ahead or I need to kind of cut some corners and shave, off some places, I want to know that up front, because nobody likes to feel like they've been through a used car dealership. I don't want to do that on the mortgage side. And at the same time, being honest, I don't want to leave money on the table. I'm not going to work for pennies when I got all this knowledge and experience that I'm putting to work for somebody. So
You're prioritizing at that point.
I would say strategizing, because this is all honesty, and some of you, I don't know if anybody's seen it yet, but my way I run my email, I work bottom up, and it doesn't matter how easy or how difficult late tasks come in. Bottom up, first in is first out, because I want to make sure that nobody slips through the cracks. And at the end of the day, yes, I guess an $800 million contract might be a little bit more important than a $200,000 contract, but it's all service and they all deserve the same amount of attention. So I'm 100% emails bottom up is how I go.
On that note, is there any specific information that agents can provide to you beforehand, before that handoff via text or call or email?
Again, I think I'm pretty chill and laid back with that respect. Just anything that coming out the gate that you think might be relevant and would be helpful in what I'm doing. In the same way that if I'm talking to somebody, and again, this has happened for quite a few times, if I'm talking to somebody and I, hear a red flag where they're like on the fence about whether or not they want to purchase, right? I'm not just going to finish my pre-approval and say, hey, Ben, your guy's good for 400,000. I'm going to be like, hey, Ben, you're good for 400. Your boy's also talking about he needs to be in a house by the next 3 weeks, or he's going to just rent because he's up against it. Like, I'm going to share that information just so that we can make sure we're working with each other and not potentially against. You know what I mean?
Because on the flip side, you don't want somebody coming into you who's only making $35,000 a year, has 40% DTI. It's like, what am I supposed to do?
Yeah, like when if you're looking at or hearing a scenario and you just already know, like, all right, they need another job, they need a co-signer, you might want to have at least, I'm not expecting you to set it up and initiate it, but you may want to drop the hint. All right, super excited that you're stoked about purchasing a home, true story, but $2,000 a month in income's not going to get us this much in this area. do you got a mom or dad or what's going on? Like, you know what I mean? Like, what's your actual plan here? You know what I'm saying? That might be helpful so that, again, when they do send in their $2,000 a month of income, I don't take that hour or two to pre-approve it, only to tell you something you probably already knew. And now we have to wait an additional 2, 3, 4 days for now somebody else to gather paperwork to now send out, when we could have already knocked all that out and been completely done and on to the next step by this point. So if you already hear stuff that you know of that is like, yeah, that's going to be a hurdle, I already know you're going to need a cosigner. Talk to them about a cosigner, figure out who's going to go on this loan. That way, when I do talk to them, we got all that information coming at the same time and we can button it up at the same time. If you know their variable income, so like nurses are popular, truck drivers, not just because those were your last two, Ben, but nurses, truck drivers, anybody self-employed, anything where it's not salary, if you know they're making a significant part of their pay in overtime, I would prep them to start digging for their year-end pay stubs for the last 2 years. That way we can see that income breakdown so that, again, when I review it, I'm not like, all right, well, they talked to you on Monday. We're finally connecting on Wednesday. They sent me their stuff on Thursday late at night. On Friday, I'm looking at their pay stubs and say, well, now I need a VOE or I need year-end pay stubs. If you already know they're in that boat, tell them up front or tell me so that I can include that in my request. This is what I'm going to need. That way we're not dragging the process longer than it needs to be. Because nothing is worse than having, at least from my opinion, having you guys waiting because I'm waiting for stuff from them. And, you know, sometimes those items aren't always easiest to find. Most of the time, if they know it, they can get it. Again, just because I've done the most recent couple with Ben, he had 2 people, both of them were variable like that. Both of them were giving a little bit pushback because it was a daunting task, which I acknowledged. I said, you know, I gave them a couple options. Both of them were able to have the document that they were dreading within maybe an hour. And we had it in our possession and we had it buttoned up the next day with their pre-approval amounts, right? So that would be the only way I would say helping, but I don't want you out here doing my job. You got enough stuff, but anything you can do, if you want it fast, anything you can do to speed it up, I would recommend that.
So, length of residence in Virginia?
What?
The length of residence question again.
Oh, yeah, sorry. Okay. So how long you have to live in the house and do you got to pay that in the state? Oh, no. Okay, so, all right.
People that obviously, it's the DMV. There's people who come from overseas like 6 months ago.
Yeah, no. As long as you have the work history, a 2-year documentable work history, you could be coming from California, not even living in Virginia, and say, I want to buy a house in Virginia. As long as you have a reason to. Let's say your job is transferring you here. You can qualify for Virginia housing.
In the state of Virginia?
The house has to be in Virginia.
Okay.
Yeah, the house has to be in the Bay. Yeah. Now, I have seen a couple or talked to a few people who are recently coming into the United States. That's where it starts to get a little bit tricky because in most cases, everybody can do what I'm asking them in theory until it's time to produce the paperwork. And this is where we start falling off the cliff. Okay. The key word is you have to have a documentable work history in your line of work is the first piece. Okay. So I have done, the most craziest recent one I did was somebody had come from Cameroon and they were doing work, sewing work, seamstress work for the military there. They somehow were able to get paperwork validating their work history that we were ultimately able to actually contact and third-party verify. That loan took a while, but we were able to track it down, get it through, and it closed, okay? Now, I had another one coincidentally out of Africa where, I can't remember the country specifically, but everything was cash. They did not keep paper records. They showed up for a day's work. They got their day's money, and that was it. Well, we can't document that one. So that one, they have to be here for 2 years working. Now, when you do get here like that, when it's recent like that, whether it's when you might be able to document the work history. If you go into a variable income situation, you have to have at the absolute minimum 12 months on that job because your income's fluctuating week to week. We don't have a way of verifying how much they're actually getting, especially when they start falling below 40 hours some weeks. So that's where it starts getting a little hairy.
I can't remember if you mentioned this earlier, but 1099 or Schedule C,
Mm-hmm.
how does it work for those? Same thing?
For Virginia housing specifically? Yeah, same thing. Just regular FHA rules. So 2-year history is your qualifying income. If income's declining from 1 year to the next, it's a 12-month history. If you recently were W-2 but decided to go 1099, you have no income until you file 2 years tax returns, but you can go back to a W-2 position as long as it's salary. Otherwise, you got to wait the time to get the income back averaged.
In the W-2 position, that still is 3 months needed?
If it's salary, 30 days. I just need a month of pay stubs for salary. If it's hourly, depending on the history and the current, it could be absolute bare minimum. You could get away with it 6 months. Most of the time, they'll want 12 months if it's an hourly position. Because again, it's fluctuating, and so you got to have that track record of, all right, we're getting ready to lend X amount of hundreds of thousands of dollars on a hope that you're going to keep working these hours.
Now, how would that work for whether it's 1099 or W-2 for those type of employees that have bonuses or different types of overtime? For example, truck drivers. That's one of the most common ones where the lender...
Truck drivers and nurses and first responders like police and stuff like that. So the tricky part with nurses is, number one, they typically work 36 hours, not 40. So technically they're considered part-time. They're not considered full-time. They may be considered full-time and for for insurance purposes at their employer, but from a mortgage perspective, anything less than 8 hours a day, 5 days a week, 40 hours a week is considered part-time, period. Okay, so when you're have all those extra different type of pays where, like, depending if you work from 12 to 1, you get an extra, your base pay plus $2 an hour, but if you work from 6 to 5, now you're getting $7. Like, when it's all weird like that, you have to have a 2-year history of that particular category of pay. Okay, so if you're getting bonuses, overtime, differential pay, mileage pay, anything outside of regular base pay rate, you got to have a 2-year history in order to qualify that income. If there's something, they just got a job promotion and now they're eligible for overtime, but they just started getting it, you can't use that income. The written guidelines say you have to have a minimum of 12 months of receipt and written guarantee that it's going to continue, which the written guarantee is going to continue is where most of those scenarios fall off because the employers aren't willing to write it. Now, if the employer writes it, we're good. But if the employer, a lot of times they'll put on there, cannot comment on likelihood of continuance is what the common verbiage they put on those VOEs. And if they put that on there, kiss of death. If it's an automated VOE, like the work number, which a lot of these big companies use, and then they come back and say, well, we have to go through the work number, kiss of death. You can't do it. And then it's the lender's fault. But your loan officer will see that and will pre-qualify that and do that up front. So your initial pre-approval might take a few extra days, but then I can at least at the beginning come back and say, here's our qualifying income, here's our issue, we can't get this verified, so we have to go with the lower amount. So it's knock on wood, pretty common. I have an issue getting a closing done because of income, because that's the most important piece, and I try to be as thorough in that as possible up front. All
I
right.
think somebody on the call had a question earlier. They opened up. I don't know. Anyone on Zoom? Did any of you guys have any questions? They're asleep.
They've checked out. All right. Anything else?
How are the rates today?
How are the rates today? That's the worst question. You know what that comparable question to that is how's the market going?
Good.
You know what? Guess what? Rates are great. They always are. No, I mean, they're average. I mean, I think with everything you have going on right now in the economy, you have the Fed cutting rates. Fantastic. You guys know the Fed doesn't set mortgage rates, right? Yep. Okay. They don't set mortgage rates. So the Fed can drop the federal funds rate 1% next month, it's not going to do anything for mortgage rates. Okay. Generally speaking, with everything going on in terms of what the Fed's doing, the government being shut down, huge segments of the population just on pause, rates are actually really good. On average, they're like low sixes and when you look up an average mortgage rate, which I do that periodically, when the agents have, I don't even answer the question anymore. I just take a screen. I just say average mortgage rate today, screenshot, send it, because there's so many variables in it. But the average rate you're looking at, typically conventional 760 credit plus 20% down. It's pretty accurate to where our rates are. But yeah, realistically, they're in like the low sixes right now. Honestly, I feel like they should be higher with everything happening and all of the mixed signals and garbage going on. I think they should be higher. But so I'm good with them, and they've been here for so long. It's pretty much in line with everybody's expectations. Unlike a year ago and 2 years ago, right around this time where rates fell and then all of a sudden they shot back up, everybody was like, well, they were supposed to fall to 3. No, they weren't supposed to fall to 3. No. But yeah, I think they're stable. I think is a good way to answer that question. Seems like they've stabilized with everything going on.
I'll just ask a
Can I
couple.
ask a question?
Yes.
I have a question.
Ah, okay.
Hi.
Hello.
Okay, I was first. Come on, you know what I'm like. So this is Farida Safi. Can you talk about the limited funds? Because sometimes when we hear that some of the loan officers will say, there was some limited funds and now it's over, so we don't offer this program for first-time home buyers, like if it is a grant program or anything. So can you just talk about this? Like if there was going to be some funds allocated and then now first come,
Yeah.
third come?
Yeah. So that's probably, and I'd rather not go into I will if y'all want to, but it's not going to really, I think, give you anything of value. So if you don't, I don't necessarily recommend getting more information on it. But it sounds like you're talking about something like Spark.
Yes.
Is that what you're talking about?
Okay.
Spark?
I don't know what it's called yet, but I thought about
None of the programs I use have fund limitations on them. And for exactly that reason, because great, you have a pipeline of pre-approved people on a program that has limited amount of funds. They're not my funds. They're some other organization's funds. And when those run out and I have to make that phone call, whose fault is it? It's not that organization. Y'all all going to be looking at me, pinging me, texting me, emailing me, calling me, talking about what happened. So I don't play around with those type of stuff, which is what Spark is. If Spark is there when the stars align and we're under contract, then great. Yeah, I'll tack on a Spark, but I'm not going to pre-qualify somebody on a Spark because right now is a perfect example. Government shut down. There is no Spark going out right now. And some of these organizations only get approved on a monthly basis, and there's a backlog of people waiting to get those funds. And they may tell you it's first come, first serve, but it's the representative fastest to fill out as many applications as who's getting those monies. So I don't ever really talk about Spark to people. I don't pre-qualify based on it. Made that mistake twice. I thought one was a fluke when it happened the second time. I was like, you can't be basing pre-approvals on something that comes and goes like that, because sellers and buyers situations don't come and go. So if it works, great. If it doesn't, we need to make sure we're still closing.
Oh, wonderful. Thank you so much.
Yep. Who was the other person that had a question?
So
I had a question. You went over the information regarding income for 2 people. You were gonna go into 4 people or more income requirement.
Yeah, it's it's 3 people or more. So it's 2 or less, and then 3 or more. So in the Northern Virginia metropolitan area, for 3 or more, it's 174.
you mean adults, right?
I mean, individuals.
Individuals.
Uh-huh.
Individuals giving kids out.
Uh-huh.
Individuals and
income.
qualifying income.
Not
Household income. Household income.
Oh.
So if you got an 18-year-old that's living at home that's working,
Yeah, but
you got to disclose it.
But they're not working.
If they're not working, then it's zero.
Yeah, that's
Yeah.
Like
So
a couple that has 6 kids.
yeah, 6. Yeah, if you're a husband and wife and you're procreating like bunnies, you're 3 or more.
yeah, they're not working. But the kids are-
And they don't work, and yeah, then all of them would be zero when they fill out the form. Yeah. Now there's certain exemptions for like dependents and stuff like that, but you still have to disclose the information.
Yeah, but it's household income.
Like parents or grandparents living.
Well, parents and grandparents is included. There is no exemption on that. But yeah, if you're a married couple and your parents are living with you and they're on Social Security and disability, their income gets factored in. There's no exemption on that one. Yeah, but if your like child has a part-time job after school that they just collect as spending money, that they usually that's not going to be an issue.
But you have to disclose.
You still have to disclose it, but they won't hit you for that typically. Now, if their part-time job is like an Instagram famous and they're pulling in $10,000 a month, Virginia Housing's probably not the program for you. If that's putting you over.
Therefore, they have the income requirement.
Yeah, because at the end of the day, they're not trying to be difficult. They just want to make sure that, with the funds that they have, which are not limited, the funds that they have are going to the right place, not people just trying to build a real estate portfolio or stretch themselves beyond their means or where they should be. They want people who genuinely need the money and the assistance to get it.
Yeah, therefore, they have all these regulations.
Correct. And they're not difficult. They're not with the new income limits that they've had out for the last 3 years or so. It's very reasonable. But there was a time in Northern Virginia where like your cap was like 112. It's like, well, I need 100 just to be here. Like that 112 don't make sense.
Gary, I have a question. Just like if I'm a new agent, right?
Mm-hmm.
Meet someone, how, like they share my income, they tell me my income is $5,000. Before I connect them with you, with a lender, how as a new agent should I qualify, if you could, we have a lot of new agents, and I would love to know as well, how would we go about that?
So there's a couple questions that you kind of want to get out in the open real fast. Number one, I think the worst question, almost like comparable to how our rates right now, the worst question you could probably ask somebody is what's your credit score? Because they're going to come back with you at a number that's definitely inflated over what it is. Because in their head, they don't want that to automatically disqualify and then close the door. So they may be on Credit Karma of all places. And then they're going to see Credit Karma is probably reading today at 620, but 5 months ago it was at 680. So I'm going to tell her 680, right? And then from there, it's going to be a hot mess when I run the credit, right? Because it's just the way Credit Karma reports. It's a different model. It's only on open and relevant accounts. It's only looking at the last 2 years, okay? So all that combined, you're usually about 40 points off on Credit Karma. I would, as an agent, would recommend, tell me what your credit score is on a scale of 1 to 10. 10 being you've never had a late payment in your entire life. Everything has always been paid on time. 1 being you've had foreclosures and bankruptcies and you can't figure it out. 5, you're average. So you've had a few missed payments, but everything's stable. Because then they're going to tell you, oh yeah, I'm a 6. So all right, got a little bit of work, but at least they're not telling you 1 or 2. Because if they tell you 1 or 2, put them in credit repair, call somebody else, right? So I would use the 1 to 10 scale. All right, and just tailor that to however you need. The next piece is how much income do you make? And then just do some rough math. If they tell you 5,000, take 50% off the top. They can't have a mortgage payment and all of their debt more than 2,500, right? What's 2,500 less what their debt that they have? Oh, I got a car payment for $1,000 and I got a few credit card bills. Well, now you know their mortgage payment can't be more than 1,500, which, I'll do the pre-approval if you want. You're not going to like it, right? And then once you know their income, ask them, what type of mortgage payment are you comfortable paying? Not what's your rent, not what are you paying now, but what are you comfortable paying? Because that's another huge question, right? If they tell you their income is 5,000, but they're comfortable paying 3,000, there's a disconnect somewhere, right? there's income somewhere else that they have access to. And that's where we need to start gearing towards, all right, all of y'all need to send in your information, right? And it can kind of help you get in a situation where we're forwarding viable people, not because I don't want to do it, but what you don't want to do is forward somebody and then you're waiting 2-3 days for results only for me to come back and tell you 175 best case. And you're going to be like, well, that was a waste, right? So I would ask those key things. Scale of 1 to 10 credit. How much do you make, and what are you comfortable paying? Because you may need to reset their expectations. They may make $10,000 a month, but they only want a $2,000 mortgage payment. Well, where do you plan on living? Because it's not going to be Woodbridge, right? And so that also helps too. So that's how I would start with getting acclimated, and then you learn from experience. Those are either great questions to ask, or I need to be asking more questions based on my clientele, because different groups, it's just facts, different groups operate and function differently. One thing that I do have to do a lot of times with people from Africa is I got to ask where their money's coming from. Because hand money, susu money, pots, and all this other stuff, can't use it. And a lot of times that's what they're banking on, right? Spanish, a lot of times their money's at home. I got to get that money into the bank, right? So as you go through those initial questions, you can kind of tailor and hone based on the results that you're getting. And then any hurdles that you have when you're getting somebody to closing, regardless of who your lender is, I don't think we've worked together yet, but regardless of who your lender is, what worked great, figure out how to get those type of results, what went wrong. And it's not always the lender, like it might be the lender's fault, but at the end of the day, it was supposed to be a team. What questions or what could I have done differently to have brought whatever issue happened to light, and then do that going forward with whoever you're working with. Because the borrowers don't know how, a lot of times. They're just trying their best, and they don't realize you can't use cash, or they don't realize you can't borrow money, and so stuff like that. Anything else?
Can I ask a question? Can you talk about this education program for the buyers, for the grant program for the first-time home buyers?
Yeah.
What do you suggest? Is that in the beginning or sometimes before closing?
It's Virginia Housing. They just have to have it done through closing. They can do it through their website, which is typically what I recommend. It's a self-paced class. They can do it online. You just go register. You get a username and password. The class it's dumb. They used to have it set up so that you could just click through and get your certificate, but now it's like our continuing education. You have to spend a certain amount of time on each screen and then pass a test at the end. You can't fail out. You just might have to take it 3 or 4 times, but it usually takes about 6 hours. And once you complete it, you get a certificate, and they can do it anytime. It just has to be done before closing, and once it's completed, it's valid for 2 years. So if you have somebody that you know is going to be doing Virginia Housing, I would just send them the link and just say, do this class, get it out the way.
Okay. One more question regarding that. What do you suggest? Okay, when they file their taxes, right, at the end of the year, is there a benefit? Can you just talk about that? When they do
with Virginia Housing? With Virginia Housing?
Yes, for Virginia Housing.
They offer something called mortgage credit certificates, which it's set up in my system to flag people who are eligible for it. But yeah, they can get added tax benefits. It's a dollar for dollar tax credit up to, I believe, $2,000 that can help them. But that's specific for first-time home buyers. I think you have to be below 80% of the area median income. But yeah, we take care of that. We set that up when we're locking the loan.
Any programs in Maryland?
First-time home buyer programs like Virginia, nothing like Virginia Housing, no. Typically, I'm using our in-house down payment assistance. Maryland has I can't remember the name of it off the top of my head.
MCC?
MCC you can do in Maryland. But in terms of specific programs, it's not like they have a comparable to Virginia Housing. They have county-specific programs. Yeah, I think the most popular is Prince George's something where they give you like 5,000, and then if you're a first responder or something like that, they give you up to 7,500. It's either they give you 5 and 75, or they give you 75 and 10. If you're a first, they give you an extra 25 if you're a first responder or something like that. But they mostly work off silent seconds, which is great when you're buying the house, not so great when you're selling the house. Just because it's extra money that you have to repay that you could have been repaying like under Virginia housings. So I typically just do one of the other ones that I have in house with them. Yeah. All right. Anything else? No? Anybody? Anything from up there? All right. That's that.
Yeah, you
No,
appreciate it.
thank you.
Thank you for sharing the interest rate for today.